So for those of you who are sick of me coming on every single episode and talking about why the markets look bearish, why 50K wasn't at the bottom, why at 30K there was still a lot of downside risk in the market, and yes, even at 20K, telling you that there is still a huge chance that we go down more from where we're at. Today, I'm going to deliver the first bit of good news that I've delivered in over a year at this point. So we're going to talk about the markets and why the bottom may have potentially been put in November when we got below 16K. So with that said, guys, if you guys are new to this channel, what we do here is data-driven analysis of the cryptocurrency markets. We've actually just released a website with the guys over at Upside Down Data. If you haven't seen their channel before, I highly suggest you head over and check it out. You can find a host of tools that we offer, which are machine learning algorithm models, and these help you to identify where market cycle peaks and bottoms may occur. We also have a range of tools that enable the short-term investor and even swing traders to identify market trends and utilize that information in order to significantly improve your market timing. We offer a full host of price metric data, which you would expect to find on a price tracking service like CoinMarketCap or CoinGecko. In addition to that, we release a weekly newsletter, which you'll find for free currently on polaritydigital.io. I'll put a link to that in the description below. So with that said, guys, let's do it. So what I'm showing here is the 20-week moving average. Now, I think that anyone watching this channel is well familiar with what this is and why it's important. So as we've talked about many times on the channel, when you're above or below this metric, it is very indicative of market directionality. So when the price is above the 20-week moving average, that is very indicative that the market is going to continue to trend higher. When we fall below, it's very indicative that the market is very likely to head lower from there. And why is that? And that's what I want to discuss today, because in and of itself, the 20-week moving average is not overly important. In fact, the 20-week moving average is nothing more than a retrospective data point. The 20-week moving average simply combines the last 20 weeks of data and takes the average of those closing points. Now, what we can see is that each time we go above or below this 20-week moving average, it strongly indicates that a new price trend has occurred, but not always. And what are the scenarios where it is important and when it's not? So as we can see that going above this 20-week moving average while you're in a bear market does happen to have a strong indication that you will continue higher from there. So as we can see has happened back here in 2015, we saw it happen here in 2019, and then again here in 2020. But interestingly, it doesn't always indicate that you are going to continue higher. So we have examples of that right here in 2020 and here in 2015, and even for a short time here in 2018. So what exactly is the difference? Well, it seems that going above this critical price level, this 20-week moving average, and holding it as support has been said is something that seems to matter. But why does the 20-week moving average have any impact on the price whatsoever? And it's not actually the 20-week moving average that is a significant driver of the price. What we're actually seeing here is what I'm going to show you right now. Okay, so what I've done here is zoomed in and I've added an additional line to the chart here. So we have this purple line, which represents the short-term holder cost basis, and we still have the 20-week moving average in white. Now, why does this matter? Why does this purple short-term holder cost basis matter? Well, first of all, let's talk about what this is. So the short-term holder cost basis shows us the average price at which short-term holders own Bitcoin. So let's talk about what short-term holders are. A short-term holder is someone who owns Bitcoin for less than 150 days. And what we find is these people that have bought within the last 150 days typically tend to have a much higher rate of selling the asset. So we find that these people are going to be coming in and are going to be very sensitive to short-term changes in the price. So when we saw this big drop back here on November 7th, it's very likely that a huge number of people that had recently bought in the previous weeks sold Bitcoin. And likewise, when we saw a huge rally on the week of the 9th of January of this year, it's very likely that a huge number of people bought into the asset, hoping for a continued run. And likewise, people that bought down here, a huge number of them took profits. And I've discussed this on many prior videos. This is backed up by data. So short-term holders tend to be people flowing into the asset and out of the asset at any given price level. They're not on average going to be people that are holding the asset for a year, 2 years, 3 years, or even longer. And so what this means is these short-term holders tend to be major resistance levels for the asset. If you're finding that short-term holders are willing to buy Bitcoin at higher price levels, that is a positive sign in the market. So we can actually see how this plays out throughout the market cycle, throughout the end of a bull market and into a bear market. So the cost basis of short-term holders back here in November of 2021, now we're going all the way back to 2021, and we're looking at their average cost. It was around $53,000. And what did the price do? Well, it came exactly down to their cost basis, okay? So we came down to their cost basis at the end of November of 2021, and we actually bounced off of it. And that's just showing you that when we got down to those short-term holders cost basis, they defended that level. But then the price crashed below it, and it did so rapidly. So we dropped below their cost basis, which was 53K. And what happened? Well, we came up and we tested it as resistance then. Because remember, as we've talked about a lot on this channel, when an area is lost as support, like it was back here in November, it then typically becomes an area of resistance, right? So we saw that happen right here in December at the end of the year of 2021. We were not able to get back above that level. And we, in fact, came and tested it yet again as an area of resistance right here in March of 22. And this is the time when we were making videos, you know, when we were down here at around 40K, saying that there's very likely going to be a large amount of resistance as we come up to these short-term holders cost basis. And that's exactly what happened, because these short-term holders are going to try to get out of the asset at even when you come back to their cost basis. So there were points when we were about 40% below the short-term holders cost basis in the end of 2021 and the beginning of 2022. Back here at the end of December and January, when we got as low as 33,000. Notice that the short-term holder cost basis was right here. It was right at around 50K still. So that implies that these short-term holders, and we'll just zoom in on this so you really see what I'm talking about. Average short-term holder was down around 33 all the way down to around 35%. So these guys were getting hammered at this time. So when we rallied back up to their average cost basis, which was down to around 46, 47K at this point, which is showing that they were capitulating, we got rejected hard off of that level. And why is that? That is because of the fact that the market was looking bearish. The Fed was raising interest rates. At that point in time, you know, the stock market was looking bearish. The Fed was raising interest rates. And as we came up to their cost basis, they were happy to get out at even, because a lot of people were worried about the fact that this is very likely over. This bull market is over and we're going to go down from here. And that's exactly what we saw. We got rejected right there off of that level, and the market tumbled down all the way down here, where we eventually wound up at 18K. And you'll notice that these weekly candles were just horrendous. We had essentially no positive price action other than a single week here in the end of May. We had a positive candle. And other than that, you know, we just got bludgeoned all through March, all the way down here through June. When we came back up and tested this short-term holder cost basis yet again, back here at 20K, so we hadn't tested it ever since around 46K, we got hammered yet again. You know, it's very likely that the timing of the FTX event was centered around this, because the powers that be knew that FTX was weak right now, and they knew that when you come to a short-term holder cost basis in a bear market, that is the point in time that you can expose someone who's looking weak. So it's very likely not a coincidence, in my opinion, that as the price came from down here at around 17.5 all the way up to around 21K, 21.5K, that is the point where the big market players knew that they would be able to expose FTX, right? Because they knew that we're at the short-term holder cost basis. where a lot of the short-term holders become very likely to sell, that's kind of when the news broke. So we weathered that storm, and where are we now? We tracked sideways all through November, all through December, and then into January. And we just exploded above this short-term holder cost basis at the beginning of January of 2023. And so what I want to do today is show you why it is that this could potentially signal to us that we have in fact put in the bottom down here when we hit a price of around 15.6 in the first week in November of 2022. So what we're looking at here is the short-term holder cost basis in white, and then we have the price of Bitcoin, this red line. When Bitcoin is in a bear market, what has going above the short-term holder cost basis meant to the market? Because what we're seeing right now is essentially playing out exactly like we've seen it in the 2014, 2015 cycle, in the 2018, and eventually into the 2019 cycle. When Bitcoin gets above this short-term holder cost basis, so as we saw back here in 2015, in the middle and end of 2015, and as we saw back here in the beginning of 2019, you find that we have done the same exact thing right now. In addition to this event only happening when the market has bottomed out and has begun its recovery, as we see in both of these scenarios, you'll notice that in each instance, if we call that the high, this high was lower, and then this high was lower. And it wasn't until we broke above that peak that we started our uptrend. At the same time, we broke above the short-term holder cost basis and began our uptrend. And the same thing happened here in 2018. We made a high, a peak, and then a lower high, and then a lower high, and then kind of plateaued, and then we dropped down. It wasn't until we broke above that prior high right here in this rally that we had in 2019 that we started our uptrend and started the eventuality that was 2021, that bull market that we went into. And you'll notice that now, for the first time in this entire rally, we have fulfilled both of those criteria that we've seen in the prior bear markets. We've made lower highs like here. So there's our high. Then we made a lower high and then a lower high and then two more lower highs. And we finally broken above this and this lower high that we made. And so we've made a higher high in this long-term downtrend that we've been making, in addition to the fact that we've finally broken above the short-term holder cost basis. So all in all, this is an encouraging sign. It's encouraging to say the least. Now, I wouldn't run and take this to the bank. I wouldn't say that just because we've surpassed these critical technical levels that are in fact going to be required in order to start an uptrend. I wouldn't say that just because that's happened, the market is going to be ready to go on a huge rally from here. But what it does tell us is that there has been an incredible amount of pain in the market ever since November of 2021. And the market has shown a classic bear market breakdown where we've made nothing but lower highs and lower lows. And we finally reversed that trend. And we've done it in a way such that we've broken above the short-term holder cost basis, and we've broken above it in a large way. So the short-term holder cost basis is at around $19,400 or so, where our price is sitting at around $23,000. This is something we want to continue to watch. If this fails, now if we cross back below that short-term holder cost basis, well, it's not the end of the world, because as we saw back here in 2015, you needed more time. You simply needed a little bit more time. But at the end of the day, the low was in. We had made the low. We went back down and tested it yet again, which we very well may do now. The important thing is we didn't go on to make lower lows from there. We trended sideways for some time between this $300 mark and this $225 mark, and we were on our way to start making an uptrend. So once you get rid of all the short-term holders that are going to panic sell every time the market is showing some weakness or some strength, they're going to take a small amount of profits. Once you get rid of all of those guys, and once you've experienced a long-term downtrend like we have, then that is the point where you can start to make a market recovery. And based on all the signs that we're seeing right now, I am hopeful that is potentially in the works at the moment. Now, like I said, we could easily come back down and test these lower levels again, and we could break below the short-term holder cost basis. But as long as we do not break down below this lower level, I think that there is a strong potential that we have made a market bottom. It could trend sideways for some time. It could take a year or more to sort of start that upwards recovery. You know, if we go back here even, this recovery was not quick. We did come up to 13K, but you'll notice that we were back down here at 5K. We just measure it from the time we broke above. It was a whole year later. So we didn't start to go make new all-time highs. In fact, we didn't make new all-time highs all the way until out here. So it was almost 2 years before we made new all-time highs again. And to sit here and say that, you know, maybe we don't make new all-time highs until 2024 or even 2025, I think that's completely reasonable. But what we want to see is the market kind of continue in this uptrend, continue to build positive momentum. We want to see the jobs numbers continue to come out positive. We want to see the Fed either kind of pause rate hikes or continue to keep them at the 25 basis points level. We don't want to see the Fed starting to raise interest rates again. We don't want to see inflation numbers coming up. So a lot of things are going to depend on the economy. You know, as long as the market and the economy don't break down, we could very well see ourselves in the process of building a new all-time high, which, like I said, may take a year or 2 years. Nothing is guaranteed to us right now. Now, with that said, this is why I've always suggested dollar cost averaging. So if you've been one of those people that's waiting for 12K or 6K or whatever it may be, you know, that's not something that I typically recommend. And, you know, as bearish as I've been very upfront with you guys and told you that I've been dollar cost averaging since essentially the beginning of 2022. It just depends on how much I'm dollar cost averaging. So at these higher levels, I'm barely buying anything. But once we get down to these lower levels, well, now I'm getting more and more into the market progressively. And this is something that I've done, and I've been very upfront about this on the channel throughout the entire year. So in spite of the fact that I own a fair amount of Bitcoin at higher levels, I have a huge amount at or below this 23K level because we have been down in this essentially below 20K ever since the middle of 2022. So I've been acquiring huge amounts of Bitcoin below 20K. And so, you know, many of the losses that I experienced throughout 2022 have been eradicated just in a single rally because of the amount that I've acquired during this lower segment of the market where we've really experienced a capitulation. So we're going to continue to watch this. This is going to be one of the most important trends in all of the crypto market, and I think it's something you guys should definitely continue to watch. That's going to be it for this one, guys. Until next time, as usual, see you.